You know, they say that those who don't learn from history are doomed to repeat it. So let me tell you a story about 2008, the Great Recession. Picture this. In 2008, the world's economy looked like a house of cards collapsing. Stock market investors saw their portfolios plummet. Some families lost their homes. Their entire retirements vanished into thin air. People who used to walk with confidence now shuffled down the street with heads hung low. They were afraid. Afraid of losing their jobs, afraid of losing their homes, and most of all, afraid of what would happen next. But here's the interesting part. Before the crash, people felt pretty much the same way. They were afraid of losing money in the market, so they held on tight to their cash. They didn't want to invest. They wanted to wait until things settled down. Sound familiar? Well, that's exactly how it was back in 2008. So let's rewind a bit and get some perspective. Imagine you're an accountant. You work hard, save money, and decide to invest some of your earnings in the stock market. Then suddenly things take a turn. The companies you invested in experience a downturn. Their sales decline and their stock prices drop. Slowly but surely, your dream portfolio shrinks from 4,000 to 3,000, then 2,000. You start worrying. Should you sell? Is this the end of your investment journey? What if your losses become even bigger? Fear grips you, and you panic, sell all your shares for $900. You feel relieved to have some cash in hand, but a few months later, the companies you sold rebound. Your shares begin to climb again, and within a year they reach new highs. It turns out you sold at the worst possible moment. This scenario isn't just a random story. It's a real-life situation faced by countless individuals during the 2008 financial crisis. Just like our fictional accountant, they made the mistake of selling their investments at the peak of the downturn, locking in their losses, and missing out on the subsequent recovery. So let me ask you, are you prepared to handle such a situation if it arises again? Remember, while we can't predict when the next market crash will occur, history teaches us that they are inevitable. The true question is, are you ready? How will you react when the music stops? If you want to be part of the solution, not the problem, join the movement. Hit that like button and become part of our community. Now let's continue. The economic outlook for 2023 is uncertain, but that shouldn't discourage us. Instead of fearing the challenges ahead, let's focus on the lessons we can learn from the past. By analyzing historical trends and understanding the reasons behind previous downturns, we can better prepare ourselves for whatever comes our way. Let's take the American housing bubble burst in 2008 as an example. The subprime mortgage crisis was fueled by several factors, including loose lending practices, inadequate regulation, and a lack of transparency in the financial system. These issues ultimately led to a sharp decline in the housing market and triggered a global financial crisis. However, this event also highlighted the importance of diversification, risk management, and due diligence. Investors who had diversified their portfolios across different asset classes were better able to weather the storm. Those who had taken the time to understand the risks involved in complex financial products were better equipped to make informed decisions. Similarly, the dot-com bubble burst in the early 2000s was driven by excessive speculation and overvaluation of internet-related stocks. This period taught us the importance of valuing companies based on their fundamentals, such as revenue, profitability, and market share, rather than just riding on the hype. It also underscored the need for investors to be wary of new technologies and industries until they have proven themselves to be sustainable and profitable. From these examples, we can see that each economic cycle has its own unique characteristics and drivers. However, there are some common themes that can help us navigate through turbulent times. Firstly, diversification is crucial. Spreading your investments across different asset classes, industries, and geographies can help you mitigate risk and reduce the impact of any single investment on your overall portfolio. Secondly, due diligence is essential. Take the time to understand the investments you're making and the risks involved. Don't rely solely on the advice of others or the hype surrounding a particular investment. Thirdly, risk management is key. Understand your risk tolerance and invest accordingly. Be prepared to adjust your portfolio as market conditions change, and don't be afraid to cut your losses on investments that aren't performing well. Lastly, keep learning. Educate yourself about financial markets and economic trends. Stay informed about the latest developments and be ready to adapt to changing circumstances. Remember, the markets will continue to fluctuate, and there will be more ups and downs in the future. But by keeping these tips in mind and constantly improving our financial literacy, we can be better prepared to weather any storm that may come our way. If you found this valuable, show your support. Hit that like button and join the movement. Together, we can build a brighter financial future. So what are the most important steps you can take today to prepare for a potential stock market crash? First and foremost, make sure you have a robust emergency fund in place. This is a safety net to cover your living expenses for 3 to 6 months in case you lose your job or face unexpected financial challenges. A solid emergency fund can alleviate a lot of stress during turbulent times. Secondly, diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This can help cushion the blow if one particular investment performs poorly. Consider investing in low-cost index funds that track the overall market, as they generally offer a good balance between risk and reward. Thirdly, consider speaking to a financial advisor who can help you create a personalized plan based on your individual circumstances. A financial advisor can provide valuable guidance and support, especially during uncertain times. Lastly, remember to stay calm and avoid making impulsive decisions. Panic selling can be detrimental to your financial well-being. Stay focused on your long-term financial goals and resist the urge to make rash decisions based on short-term market fluctuations. By following these steps, you can position yourself to weather any financial storms that may come your way. Remember, preparation and a level-headed approach can go a long way in safeguarding your financial future. Before we wrap up, let's address a pressing concern. Many of you have been asking about the current state of the banking industry and whether there's a risk of another 2008-style financial crisis. Rest assured, the situation today is very different from 2008. While there may be similarities, the banking sector has undergone significant changes and reforms since then. Regulators and financial institutions have learned from the mistakes of the past and have implemented stricter measures to ensure stability and prevent a repeat of the 2008 crisis. These measures include increased capital requirements, enhanced liquidity requirements, and stricter lending standards. Additionally, there is greater oversight and monitoring of financial institutions to identify and address potential risks promptly. Furthermore, the banking system today is much more resilient. Banks have built up larger capital buffers and hold more liquid assets to withstand financial shocks. Moreover, the Federal Deposit Insurance Corporation, FDIC, now provides deposit insurance up to $250,000 per depositor, offering greater protection for bank deposits. It's important to note that while these measures have significantly strengthened the banking industry, it's impossible to predict the future with certainty. However, based on the current indicators and analysis, experts believe that the risk of a 2008-style financial crisis is low. Nevertheless, it's always wise to be prepared and have an emergency fund in place to navigate any unexpected financial challenges that may arise. By diversifying your investments and staying informed, you can position yourself to weather any potential storms. Remember, knowledge is power, and preparation is key to securing your financial future. As we bring this video to a close, let's leave you with a final word of wisdom. In times of economic uncertainty, it's natural to feel a sense of panic and fear. However, it's important to remember that these emotions can cloud our judgment and lead to poor financial decisions. Instead, we encourage you to adopt a mindset of preparedness and resilience. Stay informed about the latest developments, keep learning, and be ready to adapt to changing circumstances. By doing so, you can navigate through any challenges that may come your way and emerge stronger on the other side. Don't let fear paralyze you. Take positive action and secure your financial future. Thank you for joining us on this journey towards financial literacy. We value your support and look forward to continuing to empower you on your path to financial success. If you found this information helpful, please don't hesitate to share it with your friends and family. Together, we can build a stronger, more resilient financial community.